tonight is tax law number 3. We'll be covering deductions and credits. Just a reminder, if you still need a hard copy of your 4012 or your 6744 test booklet, they're available 24/7 at the United Way Lancaster office located at 1910 Harrington Drive. For the York team, I will be bringing the hard copies to our Monday tour at Christmas Attics, and then I'll email you where you can pick up those booklets if you're unable to join us. As we've done in the past, please enter your questions in chat. About halfway through, we'll have a 5-minute break. We'll then come back and we'll start with those questions. We will also have questions at the end of the session. And with that, I'm going to turn it over to Jared. Thank you.
All right. Thank you, Michelle, and welcome everyone to our tax law training number 3, dealing with credits and deductions. So first 2 parts of the training had really been dealing with understanding filing status and dependency rules in training number 1. Training number 2, we went through and had talked a little bit more about the various sources of income and where they're going to be reported on the income tax return. And today what we're going to be doing is taking money away from the government. We're going to be talking about some deductions and credits here. That is actually one of the reasons why people are coming to VITA, so that they can have their taxes prepared and try and maximize their refund opportunities. So we're going to kick this off with a first discussion on a couple of our more common adjustments to income. Now, adjustments to income are actually an opportunity for taxpayers to reduce their taxable income, effectively what we call adjusted gross income, before we go through some calculations. Now, the ones that are going to be within scope here for VITA are going to be found on E1 of your 4012. And ultimately, what's going to happen, they're going to be reported on Schedule 1 of the Form 1040, and then work its way to the front of page 1 of the 1040 itself. So there are a couple that are actually within scope. We're going to talk a little bit about the Educator expenses and how those are applicable. We talked a little bit in the income section about the penalty on early withdrawal from a savings or certificate of deposit account. Fortunately, those will automatically populate from the Form 1099 INT. So as long as you have it entered correctly on that 1099 INT, it's going to automatically go to the correct portion of our 1040. We're also going to talk more about alimony paid, also an IRA deduction and how that can be applicable potentially if we need to reduce our taxable income. Student loan interest deduction, again, a popular deduction that we often see here at VITA. And also want to just to give a quick mention to the very final point here on your slide set, the tuition and fee deduction. Currently, it is not extended for 2021. However, I just want to make a quick mention because this is typically one that is a kind of a usual late extension by Congress to go ahead and allow it for the current year. Again, it is not in effect right now, but there is a possibility that it will be at some point when we go through the extension packages at the end of the year. So one thing we want to take a look at is generally with education expenses, tuition and fee, we're probably going to be better off taking a tax credit. But there might be an opportunity, again, if this tuition and fee deduction is reinstated, that a deduction might actually be preferable if we're trying to reduce our adjusted gross income or taxable income for other credits. So generally, we want to try and take a look and see which one's going to have the greater impact. And that's going to be on the Form 8917 if it is, in fact, coming back into play for 2021. But the ones that we know that are definitely going to be here are going to be our educator expenses. That's going to be found on E4 of your 4012. Much like in prior years, eligible educators can take up to $250 of qualified expenses that are paid during the year. And this is applicable for anyone who's a teacher, aide, a counselor, instructor, or principal in a school. So it actually has to be a physical location. So it can be either private or public school. Homeschool does not count. So I know with the COVID pandemic that we've had here, we've seen a lot more people go back to homeschooling. Unfortunately, any of their expenses are not considered eligible for the educator expense deduction. In addition, you have to teach in grades K through 12, so kindergarten through 12th grade, and must be employed at least 900 hours during the school year. So again, unfortunately, we do not have any opportunity for our homeschoolers to get any benefit, but we also have a kind of a series of things that could be eligible. So typically expenses would be things like any books or supplies. It could be things like computer equipment or software. Computer apps are very popular now for loading onto devices to help students with learning programs. Any other materials used in the classroom, that's kind of our traditional bulletin board material. any other supplies that they're having for the classroom. Theoretically, professional development activities are also included. One little caveat here is that they cannot be eligible for reimbursement. So oftentimes schools will allow their educators to have professional development activity. So if they choose not to get it reimbursed by the school, but they could have, it would not be eligible for an educator expense deduction. Also, we're going to talk about some unique areas within the tax code this evening. And the first one we're going to mention here is that there must be something that happened with a congressperson or a senator and their gym or physical education or health instructor, because anyone who's teaching in the health or physical education realm is not allowed to include expenses for non-athletic supplies. Athletic supplies are fine, but anything non-athletic is not allowed for deduction for any health or physical education courses. As I mentioned before, any homeschool expenses were not eligible either. And again, we have to reduce any of those qualified expenses by any reimbursements that someone may have gotten from their school. So if they spent $700 on qualified material, school reimburse them $300, we can still take that $400 as an eligible expense. And we'll talk a little bit next week about some opportunities we have to even further reduce state and local taxes, but up to $250, and that's per taxpayer. So if both spouses are educators, we can take up to $500, but it would be limited to $250 each. Another item that I just wanted to cover here is alimony. Again, fortunately did not change from prior years as well. A little bit more information can be found on the E9. So this applies for any divorces occurring after 1984 and before 2019. Any divorces that happened after 2019, the rules have changed. So alimony would not be deductible, nor would alimony received be taxable for any divorces happening in 2019 or later. So a couple rules that we have for alimony. So we are eligible to treat the payments as alimony if all of the following are true. So the payments have to be required by a divorce or separation agreement. So it has to be a legal binding document that is requiring payment. One of the interesting ones we have is the payor and the recipient cannot file a joint return. Not quite sure why this one's in here, because theoretically I would not anticipate a married couple filing a joint return to be paying alimony from one to the other, trying to take a deduction, and also having it as income on the same return. Payment has to be made in cash or cash equivalents. So that does factor in if some of the payments are actually not directly to the spouse, but paying for things like perhaps a mortgage payment or other rent payments or things along those lines, that can still be considered alimony. Another interesting part here is our first of our double negatives in the tax code. And as long as the payment is not designated as not alimony, it can still be considered alimony. So we just have to make sure when we talk to the taxpayer, and again, these haven't changed. So if they've been deducting alimony in the past, it's probably a good sign that they can continue that process moving forward. So we don't actually have to review the divorce agreement and make sure that all these conditions are there. We'll take the taxpayer's word. But as long as the agreement doesn't specify it's not alimony, also it cannot be child support, the payments have to be terminating at the death of the recipient spouse. Also, the people cannot be living in the same household as well. So just a couple other conditions there. As we mentioned, it would be deductible by the person paying it and taxable to the person receiving it. Again, as long as that divorce occurred before 2019. Again, we'll probably be taking a look at prior returns and just inquiring on the deduction side. If we saw it in the prior year, did you pay alimony for this year? And if so, just want to be sure there was not a substantial modification of the divorce agreement. Most cases probably would not be the case. As we mentioned, we also have some IRA deductions. So nicely in 2020, the upper age has been eliminated. So no longer is there a restriction on people age 70 and a half or older from making contributions to an IRA. And that's both a traditional IRA or a Roth IRA. The one we're going to be talking about tonight is really more the traditional IRA, because that's where we're going to get the tax deduction for. So the deduction has to be made by April 15th, or in this case, April 18th of 2022, the original due date of the return, in order for us to take a deduction. That can still be counted, even though the payments made in 2022 can actually be applied to the 2021 year. Contribution levels have not changed for the IRA. It's $6,000 per individual for the 2021 year. If you're age 50 or older, you actually get another $1,000. So it does actually go up to $7,000. If you are considered an active participant in a retirement plan, there could be some reduction or elimination of that deductibility if they are covered by a retirement plan at work. So how would we know that without having to ask the taxpayer or spouse whether or not they're covered? That is why we have the box 13 on the W-2. There's actually a checkbox there to say retirement plan participant. That would be indicating, as long as you fill out the W-2 and include the check mark, that will allow the calculation to go through as needed. Now, for the fortunate part for clients within VITA, typically the HEI limits are not going to be a problem. They're going to be high enough that we're not going to have an issue within our VITA program. If you are doing returns for friends or family, just bear in mind that you might not be able to get a full deduction if the individual is eligible to participate in a retirement plan at work. We may see a little bit more of that just because we're finding more and more employers who are doing this, what we call automatic enrollment plan, where even though the participant did not actively elect, if they do not elect out of the retirement plan, they're going to be considered an active participant and contributions will be made on their behalf. Another thing we would just want to talk about that we get on occasion is our student loan interest deduction. A little bit more information here on the E11, and that is basically take a look at some of the rules related to the student loan itself. The student loan, what we're basically looking for is the loan has to be for the taxpayer, the spouse, or someone who was a dependent at the time the loan was taken out. So if you have a student going off to college and you had taken out a loan and they were dependent on your return at the time the loan was taken out, you can still actually qualify. There'll be a couple eligibility rules we'll talk about in just a minute. But for that loan itself, it has to be paid within a reasonable amount of time after you get the loan. It has to be used for an eligible student, basically what we call half-time at an accredited school. So again, Department of Education would be determining whether or not that school is considered accredited. Most schools that offer a degreed program would be considered accredited. There are, obviously, we have to watch to make sure that someone's not going to a school that is really not eligible for student loans. Typically, what you're going to get is a 1098E from the student loan provider. So the 1098E is going to indicate the amount of interest actually paid on the year. And we're allowed to take the lower of either the amount of interest paid or $2,500. So for example, if you have a 1098E or maybe a series of 1098Es and you add them up and it's $1,200, just simply enter $1,200 into TaxSlayer. Program's automatically to calculate the lower of those two numbers. You don't have to do any math at all. If you add them up and they're $4,000, go ahead and put $4,000 in there because the system's going to know to only take the $2,500. A couple other issues I just want to point out about the eligibility for the student loan interest. You may not file married filing separately. Again, it's going to be an issue that we take a look at here. It's going to prevent us from taking a lot of deductions and credits this evening. Also, you cannot take the student loan interest deduction if you are claimed as a dependent on someone else's return. So if a college student is still in school and they're being claimed by their dependent or they're being claimed as a dependent by their parents, they are not eligible to take the student loan interest deduction. Another question we sometimes get is who is actually eligible to take the deduction? Well, in order to take the deduction, you have to be legally obligated to pay the loan. So if you are a co-signer on the loan, typically you're legally obligated to pay the loan. If you would like to pay off a student loan on behalf of a grandchild or a niece or a nephew or a family friend, you are not eligible to take the student loan interest deduction. However, they can. So if someone else is actually paying the loan, the payment is going to be treated as the made by the individual who is actually legally liable for the loan. So if we can't take the deduction on our taxpayer's return, we may be able to suggest that it goes back to the actual student from which the loan is intended for. Again, the loan proceeds have to be used for paying tuition or other qualified higher education costs. That does include books, and it also includes room and board. So it's a little bit more involved than what we're going to see a little bit later with the education credits, but it can include room and board as well. Another thing I just want to point out, we had a change in 2019 under the Secure Act, well, which is really more of a retirement act than a real true tax act. But under the Secure Act, we can take up to $10,000 total over a total lifetime out of a Section 529 plan to actually pay for student loan interest or student loan principal. So again, we may not see that all that often in VITA, but I just wanted to put a quick reminder in here for people who might be looking at planning around student loan interest deduction and payment rules. One of the last ones we want to talk about from a deduction perspective is actually a charitable deduction. So again, on F10, a little bit more information on how that charitable deduction will work. It is available only for 2020 was the first year we saw it. It's available again for 2021. At this point, it is not extended. This would be the final year that we'd have the charitable deduction. So for taxpayers who do not itemize deduction, and quite often in VITA, we do not have itemized deductions, we will be talking about who can qualify for itemization immediately after our break this evening. But they can take up to $300 of charitable contributions per return. Now, if you're a married filing joint return, you can take up to $600. That's a change from the prior year. Last year was only $300 per return. This year, you can actually take up to $600 if you're filing jointly. A couple things that we just want to remind you of: the contributions have to be made in cash. And when we say cash, obviously it means we can also do check or credit card or something else. But what we mean is it cannot be donating clothing or furniture or non-cash type property. So it has to be a cash donation. We do have some substantiation rules. So again, typically within VITA, we will take the taxpayer's word, but just remind them that we're not the ones who ultimately would be double checking their receipts and information. That would be falling on them in case the IRS would ever have a question with it. So basically what we take a look at for substantiation, if there's a contribution of $250 or more, the taxpayer should have a written receipt to demonstrate that that was a actual charitable contribution. Now we'll get into some of the non-refundable credits, and we keep calling it non-refundable credits. That's kind of where they're still sitting here on the 4012, although some of these have actually changed dramatically for the 2021 year. First one I just want to talk about here is the foreign tax credit. A little bit more information for that will be found on the G7. It does say Form 1116 if required. I highly recommend we do not file the Form 1116. We actually have a much easier process. Foreign taxes typically would arise because an individual has some sort of investment in a foreign entity, whether that is through a mutual fund or direct stock ownership. But typically we're going to see these reported on brokerage account statements. So the good news is if you actually have a foreign tax credit of 300 or less, or 600 if you're married filing jointly, and it's coming from a specific form, a 1099 INT, a 1099 DIV, or a Schedule K1, then we can actually go ahead and make an election to report that directly on the Schedule 3 line 1. We do not need to file a Form 1116. Usually the easiest way to do that, I do want to mention that for the Schedule K1, that is technically not within scope here for VITA. But certainly if you're preparing friends and family, you could actually go ahead and complete that form if need to be, if you feel comfortable with that. But the easiest way to go ahead and do the foreign tax credit is to opt out of filing the Form 1116 and just put that amount, 300 or less or 600 or less if married filing jointly, directly in the input screen on our form. I believe if you're actually using the software and you enter that information in the income line, it should go ahead and automatically populate that for you. We'll be getting into a lot more detail here in terms of a couple different areas: child and dependent care credit, the Form 2441. That is a big change from the prior year. The next two, fortunately, are not big changes. We actually have the same education credits, the Form 8863, and the same retirement savers contribution credit, Form 8880. And I'll just give you a couple reminders of how those would work as we move forward. Now, for the child and dependent care credit, this one has now moved from a non-refundable credit to a fully refundable in 2021. Now, this applies only if the taxpayer lived in the U.S. for more than half the year. I don't think it should be a problem within VITA, but just wanted to make sure that we are eligible to take this only if the individual lived in the U.S. for more than half the year. Then it is fully refundable. A couple big things I want to point out to you here. The maximum qualifying expenses has increased dramatically. Last year and in all prior years, it was only $3,000 for one child. it has now moved up to $8,000 for one child. In prior years, it was up to $6,000 if you had more than one child. Now that is $10,000 higher. So it's now $16,000 of maximum qualifying expenses for more than one child. The other thing that we're seeing here as well is that the credit ranges now used to be 35%. Now it's up to 50%. So theoretically, if you have more than one child, you could get an $8,000 credit for child independent care, which would then become refundable. So the credit ranges from 50% to 20%, depending on your adjusted gross income or AGI. Now, what has changed is they actually now started to phase this out for adjusted gross income above $400,000. But the good news is for VITA, we do not have to worry about clients with AGIs above $400,000 because we're not going to be working with those. A couple of things I just want to point out when you fill out the W-2. Just be sure you take a look and see if there's any amount in box 10. It's kind of easy to kind of overlook that, but every once in a while we'll see someone who has elected to make a pre-tax contribution for dependent care assistance. Now that's actually increased from a perspective of $5,000 maximum up to $10,500. So we want to be sure we include that on the W-2. If not, it's going to trigger a tax notice a little bit later. But again, if you just enter the W-2 exactly as presented, we should be in great shape. Any amount entered on box 10 is immediately going to go over to the form 2441 and act as a reduction of the maximum qualifying expenses. So when we're taking a look at the child and dependent care credit, there's a couple eligibility rules that we have. So the first one is that the care must be for one or more qualifying persons. When we talk about the traditional one, is pretty much a child under the age of 13, and it can be claimed as a dependent. So the one issue we talked about with our dependency exemption is if you have a custodial parent, they can actually waive the dependency exemption by filing the form 8332 and allowing the non-custodial parent to take the child credit. That'll also allow them, again, the child tax credit and the dependency exemption. For purposes of the child independent care, only the custodial parent, only the one who is physical custody of the child, is allowed to take the child independent care credit. So the qualifying person has to live with the taxpayer for more than half the year. So some other ones, so qualifying child, our traditional one, that can be anything from a before school or after school care. It can actually include things like summer camps or other programs, as long as they're not an overnight camp. So if you send your kids off to a soccer camp or Lego camp or space camp, as long as it's not overnight, that can actually qualify for child independent care. I'll just make mention of a couple things along the lines as well, that in order to claim the credit, we have to have a social security number or employer identification number of the provider. So that is a requirement. You may talk to an individual and you ask if they've had childcare expenses, and they say, absolutely, we have. We have a nice neighbor down the street that'll watch our child after school. And the next step we need to know is how much were they paid, what's their name, what's their address, and do you have their identification number? If we don't have the identification number, we cannot take the child independent care credit. Institutions are pretty good about giving out their EIN. Individuals may not be. And again, what would happen is the IRS is going to be matching up the EIN or social security number that we're reporting on that form 2441 with the provider's Schedule C or business activity to make sure that they're actually reporting in its income. So there are times that we may have people and if that's the case, if they're being provided childcare, but we do not get the EIN or social security number, we cannot take that deduction. So again, we cannot force the provider to go ahead and file a return, but technically that money should be reported as income. So we cannot take the credit if we don't have that information. So in addition to child under the age of 13, apparently under the IRS rules, once you're a teenager, you're completely capable of taking care of yourself. You can bathe yourself, feed yourself, do your own laundry, but that's the IRS's position. But in addition to children, we also have a dependent of the taxpayer that's not physically or mentally capable of taking care of themselves. Now, I know that you're probably thinking, all right, I have teenagers that probably don't do very well at taking care of themselves, but we basically need to have some sort of condition that is a physical or mental condition that they are incapable of caring for themselves. And we're typically taking a look at a provision that they either cannot dress themselves, they cannot clean themselves or feed themselves, that they need some sort of care to be able to help with that. Also includes anyone who might need additional assistance or constant supervision to prevent injuries to themselves. So if they have a tendency to fall or self-harm, that can be an opportunity as well for a child in dependent care. In addition, if you're taking care of a spouse, that would also be qualifying as well. So if you're paying for care for someone's spouse who's mentally or physically incapable of taking care of him or herself, as long as, again, they lived in your house for more than half the year, then we'd be in good shape. So if we're filing jointly, one thing we need to know is that we have to have both spouses having earned income unless it's the spouse that is actually receiving the care. In that case, that doesn't have to happen. A couple other exceptions would be if you have a full-time college student or if someone's actively looking for work. And the actively looking for work, we have to make sure they're actually actively looking for work, not just updated the resume and have it out on a website. It has to actively be looking for work. But generally, you have to have earned income. And we'll talk a lot more about the earned income credit a little bit later, but you have to have earned income in order to qualify. A couple other little quick pointers I wanted to mention here in relation to the child and dependent care credit. When you're filling out the form 2441, again, as a reminder, you need to have the name, address, and identification number of the individual providing care, but there's actually a two-step process. The first step is to actually enter all the information from the person providing care. And then the second step is you have to associate those costs with the individual who qualifies. So if you don't do both steps, the credit will not be calculated. And when you take a look at the 2441, there's actually a kind of a reconciliation form, if you will, at the very top that'll say the amount of qualifying expenses and then the amount allocated, and then they'll show a difference. As long as you get that difference down to zero, we should be in pretty good shape. Wanted to also talk a little bit more about education credits. So once you actually have a child who's now getting out of the school system and they're pretty good about taking care of themselves and they're heading off to college, we want to talk a little bit more about education. So qualifying education credits would be for two different options here. We have the American Opportunity Credit and the Lifetime Learning Credit. A number of these are fairly similar in their base, but we're going to take a look at some differences on the next slide. So in order to be eligible, we're looking at either the taxpayer, the spouse, and or their dependents who are actually claimed on the return. And again, similar to the student loan interest, they have to be attending an eligible post-secondary educational institution. They cannot be claimed as a dependent on another return. So what this basically means is that a college student cannot take the credit for themselves if they're being claimed as a dependent on someone else's return. If the parent chooses not to claim them as a dependent, however, then the student could potentially take the education credit. Now, in a lot of cases, the student may not have sufficient income in order to get a significant benefit from the education credit, but they cannot take it if they're a dependent on someone else's return. In addition, a filing status that cannot take the education credits are married filing separately. Traditionally, what we're looking at here for the education credits are kind of your tuition and any related expenses associated for enrollment or attendance. And we'll talk a little bit about those differences between the two opportunity credits and the lifetime learning credit in just a minute, which will actually qualify. But traditionally, any tuition would count. Where we're going to see that information is actually coming off the Form 1098T. So it's something that you should be getting back from the students. We'll need that information in order to complete the credit because we need to enter the name of the institution. We need to go through and complete the employer identification number and also get some of the pieces of information off of that form. What does not qualify are room and board expenses. So living on campus, dining on campus does not count. Any transportation costs back and forth to college doesn't count. Buying furniture doesn't count. Any personal expenses. So if you do the traditional drop the kids off at college and you want to go ahead and head to the bookstore and load up on all kinds of sweatshirts and t-shirts and everything else, those are not deductible expenses. Those are considered personal expenses. Now, I did mention about the, two different credits. So the first one is going to be the American Opportunity Credit. And in order to get the maximum credit, we only need $4,000 of eligible costs. Now, the good news is, in case you haven't priced colleges lately, $4,000 is not a difficult number to come up with. Now, this is permitted only for the first 4 years of post-secondary education. So it only counts for the first 4 years that a student is actually at an institution. And it can only be claimed for 4 years as well. Now, the nice part is this credit can be up to $2,500. So we don't need that much in cost in order to maximize the credit. Now, the one interesting part we're talking about that 4 years is traditionally students are actually at an institution for 5 calendar years. Typically, if you'd be taking a look at a college student who is just starting off first year, they're enrolling here in September of 2021 or August, depending on when their school starts. Then they have 3 full years of school, and then they have a 5th year, which they're graduating predominantly in May. So even though they have 4 academic years, it's actually spanning 5 years. And you're thinking, well, we have a little bit of a mismatch. Well, the fortunate part is colleges typically will bill for their tuition before you even go on campus. So right around here, late November, is when we might start seeing those bills coming out for the spring semester after the students have already started enrolling. So the credit is allowing you to take any costs that you pay for the current year, so anything for 2021, including any courses of study that are started in 2021 or starting within the first 3 months of 2022. So if you get a bill for tuition here, November, December for $5,000 for semester starting in January, the $5,000 of costs are actually going to be used on the 2021 return. So even though we have a little bit of a discrepancy there about the 4 years, typically we can actually get the first 4 years in the first 4 calendar years, the individuals at school. Again, the nice part about the American Opportunity Credit is up to 40% of the credit is refundable. So out of the $2,500 credit, 40% or $1,000 can actually result in a federal refund, even if they do not have any tax liability. A couple other restrictions, though, for the American Opportunity Credit. That would be a program has to lead to a degree or certification. You have to be at least 50% part of the normal full-time workload. The fortunate part is the Form 1098T is actually going to go ahead and give you a checkbox to see whether or not they are considered at least half-time student. Now, question that we have to ask, an odd question we have to go ahead and ask is, was the student convicted of a felony drug conviction by the end of 2021? If they are convicted of a felony drug conviction, the American Opportunity Credit will not apply. Now, we do not have to go into their entire legal history because actually any other felony is fine. If you have a student who was convicted of aggravated assault, kidnapping, terrorist threats, hijacking, whatever it is, that's fine, as long as it's not a felony drug conviction. So again, when we take a look at how bills are designed in Congress, apparently we did not want to help support former drug felons to go back to college. Any other felony is fine. A drug misdemeanor is fine as well. It just cannot be a felony drug conviction. So we just have to ask that question. But the good news is, if someone does say, yes, I do actually have a felony drug conviction, all is not lost because we do have another credit available, which is called the Lifetime Learning Credit. Credit's not quite as powerful. It's actually only 20% of each dollar up to the first $10,000 of qualified tuition. The $2,000 is not refundable, so it's only going to be able to offset your taxable income. But the good news is there's no limit for the number of years the credit can be claimed. So you can take this for students that are on that 7 or 8 year undergraduate plan. You can take this for students who are going for a master's or doctoral degree, or if you have an individual who's just taking a credit at a time. They want to go back and go to a local institution and learn more about astronomy or learn to take French or anything along those lines, they can actually go ahead and take the Lifetime Learning Credit. Now, one of the other restrictions in addition for it not being refundable is that it's basically just tuition and then any books, fees, supplies, required equipment that are purchased directly from the institution. So under the American Opportunity Credit, it doesn't matter where you get your books and supplies from. If you want to rent the textbooks, if you want to go to Amazon, if you want to purchase them that way, that's fine. But for the Lifetime Learning Credit, they have to be purchased from the institution. So again, as we mentioned, no requirement for the half-time enrollment. And again, the felony drug conviction are welcome to take the Lifetime Learning Credit. So when we take a look at the education credit, again, the Form 1098T is going to be our main driving force behind that. There is more information on the J7 about how to take some of the information off of that Form 1098T. Now, you may need to get a little bit more information because 1098T does not always give you all the detail that you need to complete the credit. However, again, if you're taking the American Opportunity Credit and you see $30,000 for tuition, we do need to back off any amounts included for scholarship that's not eligible as a deduction. So if they have a $30,000 tuition and a $16,000 scholarship, we're still talking $14,000. We should be in pretty good shape there to take the American Opportunity Credit and also the Lifetime Learning Credit. But any payments that are made to college are going to count whether they're made by cash or credit card or borrowed funds. So you can actually borrow money on student loans and still be eligible for the education credit. Again, as I mentioned, the scholarship money is not eligible, not considered a education qualifying cost. However, if you have another individual in the family, maybe a grandparent or someone else who's actually wanting to go ahead and pay for a college education, those payments do count for the credit purposes. So any funds paid by another person is actually treated as being paid by the student. If the student is actually a dependent of the parent, then the parent can actually claim those costs as a credit. So that's our education credit. Fortunately, no changes there from prior years. And another one without any changes is going to be our retirement savers credit. This is coming off the form 8880 and a little bit more information on the G15. Typically, this credit will try and automatically calculate if you're filling out the W-2. And where this credit comes into account is if taxpayers have made a contribution to a retirement plan. They might be eligible to actually get part of that money back in the form of a non-refundable credit. Now, this also includes traditional or Roth IRA. So one of the interesting parts is that the traditional IRA we had talked about under deduction. So we should be asking if someone has made a contribution to a traditional IRA. But we also have to ask, did they make a contribution to a Roth IRA? So a Roth IRA, even though they don't get a tax deduction for it and the proceeds are going to be tax-free, they are still eligible for that retirement savers contribution credit, as well as any elective contributions to a 401k or 403b. Those are our traditional plans that you have working for a for-profit employer or maybe a government or nonprofit, a 403b. Also, any elective deferrals to a government 457 or SEP or simple plan would also be eligible. And you might be asking, how do we know those contributions? Well, those are fortunately found in box 12 of the W-2. So as long as we're entering the codes incorrectly, they're going to flow over to the form 8880. So the typical codes are going to be the D, the E, the F, the G, the H, the S, the double A, or the double B. And now it feels like I'm either calling bingo or trying to find the right size batteries. But those are the codes that will be showing up on the W-2 and will automatically apply for the form 8880. Now, a couple other restrictions. The taxpayer cannot be a dependent or a full-time student. Now, typically when we fill out the intake form or they have the basic taxpayer information, we're going to indicate whether or not they're a dependent or full-time student, which will automatically prevent this from calculation. Also, we're going to fill in the birth date, so we don't really need to worry too much about this date, but I just want to make mention, most times we're looking at dates, we're typically looking at the end of the year, determining, say, your marital status on December 31st. This is unique. This is actually looking at a January 2nd date. So the taxpayer has to be born before January 2nd, 2004. So that means they could actually be born on January 1st, 2004 and be eligible. So again, a little interesting wrinkle in the tax rule here. I'm not quite sure which member of Congress was born on New Year's Day. Probably felt slighted in the past that they didn't have the full benefit of a celebration for their birthday. People are usually up really late the night before celebrating the new year. And unless you really enjoy pork and sauerkraut for your birthday dinner, for those of you from Central PA probably understand we have a lot of pork and sauerkraut on New Year's Day from the PA Dutch traditions, but that would be eligible. If you're born on New Year's Day, you get a little bit of a break. You can actually take the retirement savers credit a year before everyone else that was born in 2004. Now, the one other thing we do have to just check on or ask is that if you have a eligible contribution, you have to reduce that by any retirement distributions taken in the prior 2 taxable years. So you just have to go back and double check to see, did anyone actually make a distribution from their retirement account in the prior 2 years? And the reason why I mention this is that typically we may see retirement distributions in prior years due to a person changing jobs and basically taking the cash out of that plan. Last year for 2020, as we mentioned, we had the opportunity for individuals to go ahead and take money out of their retirement plan without a penalty for early withdrawal. So we did see some people take advantage of that program and take out penalty-free withdrawals from a retirement plan, still subject to tax, but at least penalty-free. So if they have a distribution from retirement account in the prior 2 taxable years, we have to reduce the amount eligible for the credit by those distributions. So again, another reason why we may need to go ahead and take a look at some of the prior year information and be sure that we are accounting for that appropriately. All right, so taking a look at a couple other credits here, want to mention some of the largest changes we're going to have. We're going to start off by talking about the child tax and credit for other dependents. We're also going to be talking about the earned income credit, another big change that we have. We're going to pick that one back up after the break. But one other thing I want to just mention here while we're talking about credits and payments is the estimated tax payments. We don't see it all that often within VITA, but we just want to be sure that we're using those estimated payments effectively. H7 of your 4012 will give you a little bit more information about how to enter those. So if an individual had either a prior year carryover, decided to apply an overpayment to the current year, or they made estimates to help offset their current year tax liability, we just want to be sure that they're actually entered correctly. So want to be sure that we actually have that going in play for the current year. All right. So now the big one changed, the first of the major ones that we have here. So want to talk a little bit more about the refundable child tax credit. Again, more information on G2. This is one of our massive changes for a couple reasons. One is we've actually seen an increase in the amount of maximum credit for children. So before it used to be $2,000 per qualifying child. Now it's up to $3,000 per qualifying child, but we also see a change in ages. So it's a $3,000 eligible credit for people between the ages of 6, and now it's been bumped up to 17. In prior years, it was only up to the age of 16 was eligible. So 17-year-olds did not qualify for the credit. They were in kind of a gap year. They were kind of in between the child tax credit and probably before they went off to college for the education credit. But now that that credit has been bumped up to age 17, so between the ages of 6 and 17, it's a $3,000 eligible credit for each child. If a child's under the age of 6, or for those of you who enjoy seeing math a little bit differently, is 5 or under, that would be a $3,600 credit amount. So again, the eligibility rules, you have to be under the age of 18 at the end of the tax year. You have to be a U.S. citizen, a U.S. national, or a resident alien. Excuse me. And you have to be claimed as a taxpayer's dependent. So in order to go ahead and claim this, they have to be a dependent on the return. Again, as we mentioned before, a non-custodial parent may take the child as a dependent, which also entitles them to the child tax credit, as long as that signed 8332 is attached to the return. The child must have a valid Social Security number by the due date of the return. So you're not allowed to amend to go back and put that in for a Social Security number that's achieved later. They have to have a valid Social Security number by the date that you file the return. Now, the bottom section here, we actually had a portion of this that was non-refundable and then became refundable in certain aspects. The whole child tax credit now is refundable for the year 2021. Now, the additional child tax credit would only apply for those who live outside the U.S. So I don't think we're going to see that many in VITA, but I do have some information there for anyone who is potentially working on a foreign return or may have a personal return where the individual is not located inside the U.S. One of the other major changes we had seen with the child tax credit is the IRS began advanced payments of these credits starting in July of 2021. Now, taxpayers were getting notification. They could either opt out or they could modify their information to change the amount that they were actually receiving or update the IRS if they had fewer children than what the IRS had anticipated. Now, the good news is that this advanced payment was only 50% of the estimated credit. And why do we say that's good news? Because if individuals are expecting a relatively high refund, and that refund was predominantly generated from the child tax credit, they've actually been getting that credit for the last few months on a monthly basis. So that means that their refund that they might have been counting on here when they file their return would be dramatically limited because they actually received up to half of that credit already. Now, how do we understand if an individual had received the advanced child tax credit payment? Well, step number one, we ask them. Step number two is that they should be getting a form or letter 6419 at the end of the year from the IRS. Should be received by probably the end of January from the IRS that indicates how much they've actually received in advance payments. They also should have the ability, we believe the IRS is going to have a lookup feature on their website to determine how much of advance payments were actually received for the child tax credit. Now, they may have actually received too much advance payment. And how could this arise? Well, it could happen that that you had a child who was on your return for 2020 who is now living with someone else. That it could be a situation where that you have shared custody, or maybe you're switching those around. So it may be that the child that you had in a prior year return may now be with someone else for the 2021 year. Again, they would have had the opportunity to modify that with the IRS, but in case they didn't, there could be a situation where someone's received too much. Likewise, an income could have changed from a prior year. Now, we probably won't see that here within VITA. The income is probably going to be fine for most people. It could be a filing status change. It could be a divorce that occurred or something else that they're no longer eligible to take a child on the return. So the next question is, what if they got an advance payment and they weren't eligible to keep it? Do they have to pay it back? And our favorite answer within tax is it depends. So one of the things we're taking a look at with this advanced child tax credit situation is we actually have a full payment protection. So you don't have to repay the amount in full at all. If your AGI or adjusted gross income, again, for 2021 is below $60,000 for a married filing jointly or a qualified widower or widow. So that's actually pretty close to the top range that we have for our VITA program. So as long as you're under 60,000, if you're married filing jointly or qualifying widower, you're okay. It goes down to $50,000 for head of household and drops to $40,000 for a single or married filing separately. Now, we probably will be seeing some additional input areas within our tax layer program for the advanced child tax credit payment. And theoretically, anyone who's received advanced child tax credit payment should be filing a return to have that reconciliation feature in place. So just to point out a couple other things there. Now, we still have the credit for other dependents. So this again found on G6, this is for people who no longer qualify for the child tax credit. So again, the child tax credit goes up to age 17, but what happens to your children who are 18 or older who still qualify as a dependent on your return? They can still get that $500 credit. So this is basically the eligibility rules as a dependent who cannot qualify for the child tax credit for anyone else. You can apply the dependency test from the qualified relative chart. So the biggest ones we see for the other dependent might be your college age dependents. It could also be elderly parents or other qualifying relatives. So the dependent has to be a U.S. citizen, a U.S. national, or resident here in the U.S. They cannot be a resident of Mexico or Canada, and they must have a valid identification number, that social security number, the I-10 or the A-10, the adoption tax identification number, again, by the due date of the return. All right, so I wanted to just hit one more credit before we hit the break here, and that's going to be for energy credits. Now, these energy credits are extended now through December 31st, 2021. These, very much like that tuition and fee deduction, are typically late year extenders. We often see those extended by Congress, but right near the end of the year, if they're beginning of the next. The information for this is actually found in the extension, extended tax break piece of your 4012. So it's under actually EXT-6, so very beginning of your 4012. Now, one of the big ones we take a look at, where we see a lot of these energy credits, are what we call residential energy efficiency property. These are actually outside the scope of VITA, but where these are pretty much your qualified solar, electric, any solar water heater, any geothermal, any wind turbines. So those are actually outside the scope of VITA. So if you have a client coming in and they say, I just put a new geothermal system in and a couple wind turbines on my property, unfortunately, at that point in time, we're going to gather up all their information, put in a nice tidy package, and thank them for coming in because we can't prepare the return. A little bit more complex to complete the Form 5695, at least part one. What we can help them out with, however, is the Form 5695 Part 2, and that's actually non-business energy property. Now, one of the caveats here is that the total combined credit is only $500 for all of your tax years since 2005. So we have to kind of go back and double check, did the taxpayer have any energy credits for a non-business property from 2006 moving forward? If so, you only can take up to $500 in total. Out of that $500, only $200 can be used for windows. They have to be improvements made to the taxpayer's main home, cannot be a vacation or rental property. Highly encourage you to take a look at the instructions for the Form 5695 to determine what actually qualifies and what the energy efficiency ratings would be. The common items would be things like a non-solar water heater, HVAC systems, particularly air handlers, biomass stoves, which we're seeing a little bit more of now, any exterior windows and doors, any metal or asphalt roofs, and insulation. So usually where we'll see this come in from VITA is because an individual has worked with a contractor who has mentioned that they're going to be eligible for an energy credit on the return. So they might be bringing some documentation coming in, whether it's a kind of a form coming in here from the contractor saying what the energy efficiency is, or some sort of certification of the property itself. So we can go ahead and take a look at that. Again, it may just take a little bit more time. I'm not anticipating we're going to see a lot of these this tax year, but we did see a lot more people go through home improvements last year through COVID. A little bit more extra money coming in, maybe from stimulus, and people may have been doing some home improvements. So if they do qualify, we certainly can prepare that for them on the 5695. So that'll actually take us up to our first break here. So we'll go ahead and take a break for about 5 minutes and regroup again around. All right, welcome back, everyone. Wanted to take a little bit of time now and answer a couple questions that might have been popping up during the chat or from our session a little bit earlier today. So I wanted to see, Jeff, do we have anything we wanted to go over?
We do. Thanks, Garrett.
All right.
I'll bring in the questions from this morning. First, there was a follow-up from the income topics from last week relating to 1099-Bs and brokerage fees. The question is, can management fees from the broker be applied to a 1099-B cost basis? If so, how do you split between short and long?
Okay, so one of the questions we sometimes have for cost basis when we take a look at the definition, it includes the purchase price paid for stock or securities, bonds, whatever the case may be, plus any commissions. Now, commissions that you're paying on stocks are added to basis. However, investment management fees are not allowed for a deduction. So they're not allowed to be deducted on some miscellaneous itemized deduction anymore, nor are we allowed to allocate those to various components of stocks or bonds. It's actually a separate management fee and not related to the transaction piece itself. So it's only allowed if we have a transaction with a stock that can get us to that ability for a added to basis.
All right. Thanks for that. Now, questions for from tonight's subject matter. First question, are the alimony rules applicable to spousal support as well? For example, the spouse supports is pre-divorce after separation.
Yeah, technically the alimony rules would apply for final divorces. Now there can be some court-ordered separation payments while in process. Now that's generally while the divorce is still ongoing. So the rules have changed here after 2018. So I would not anticipate that we would still have any divorces in progress from over 3 or 4 years ago at this point, that it probably should be finalized. So if the divorce agreement was completed after December 31st, 2018, then the alimony would not be deductible by the payor and not taxable by the recipient. Likewise, if you had a substantial modification in the agreement after December 31st, 2018, that would take away the payments as well for being deductible by the payor and taxable by the recipient.
Okay, got it. Thanks for that. Next question. Will the taxpayer receive a form from the broker to show their Roth or traditional IRA contributions?
Yes. So typically for Roth or IRA contributions, you should be getting a form 5498 from your third-party administrator, your provider, showing how much you had actually contributed to the account for the year so far. So that would predominantly be kind of issued right near with the rest of your financial statements as well. Oftentimes, if someone has a brokerage account, they can look that up and prepare one in case that the forms haven't been filed yet by the broker or third-party administrator. But it'd be the Form 5498.
Okay. Next question. Are there any AGI requirements for the child tax credit?
So that was, you said an AGI requirement for the child tax credit. So the
Yes.
ones really there are, but for VITA purposes, we're not going to be hitting those traditionally here. They're going to be much higher. They usually phase out well above our income thresholds for VITA. So if they're a VITA based client, that should not be applicable for the child tax credit.
Okay. Now some questions from tonight's chat.
Yeah.
Does one have to have earned income to make an IRA contribution?
So yes, so technically for both a regular and a Roth IRA, there has to be an element of earned income. So in order to be eligible, you have to have your own earned income if you're filing singly, if you're not in a married filing jointly situation. So you have to have your own earned income. Now, if you are in a married filing jointly position, you can actually use your spouse's earned income in what we call a spousal IRA. So if your spouse has at least 6,000 or 7,000, depending on your age, of earned income, you can actually make a spousal IRA contribution using their earned income. So you can actually, on a joint return, use up to the combined amount of earned income between the two parties. But yeah, so if you have a 8-year-old child who wants to contribute to an IRA, unless they have reported earned income either from wages or self-employment, they would not be eligible for an IRA contribution.
All right. I think you kind of answered this in that answer, but if you're married filing jointly and one spouse does not have a retirement plan, the other does this eliminate the IRA deduction?
No. So the IRA deduction can still be in place. And again, usually for the phase outs we see with the AGI, they really won't be impacting many of our VITA clients at all because of the high nature of the AGI. But a spouse can always contribute to their own plan, even if the other taxpayer is participating in a plan. So again, we can kind of take a look at the deductibility. There's actually some nice options if they have the available funds to go ahead and either do a Roth or a regular IRA contribution on the return.
All right. If someone is remarried and paying alimony, is it still deductible if they MFJ with their current spouse?
Yeah. So if we're looking at someone who's actually required to pay alimony, there's no requirement that or no opportunity for that alimony to stop if they get remarried. I actually have a number of clients that have an alimony situation and are remarried, filing jointly with their new spouse, and they are still eligible to take the alimony deduction, again, as long as they meet all the other rules, and predominantly that divorce occurred prior to or was finalized by December 31st, 2018.
All right. How much is the charitable contribution? Sorry, the charitable deduction per head of household?
That'd be $300. So it's $300 for all returns unless you're married filing jointly. That would go up to $600. So it's still $300 for head of household or any other status other than married filing jointly.
Okay. If a college student could be claimed as a dependent of his or her parents, but the parents chose not to do so, can the student claim the education credit?
So this is kind of an interesting situation. So the technical rule is that only one person should be eligible to claim the child. If the parent had actually provided more than half the support, I'm sorry, if the child didn't provide more than half their support, then they could be claimed as a dependent of someone else. Now, the actual rule is that you can, if the parent does not claim the child as a dependent, that the child can then file the return claiming themselves and be able to be eligible for the credit. And actually, TaxSlayer had a pretty nice article on this, I believe back in July of about 2020, that kind of describes some college tax planning and actually has that same situation that they have walked through, that the parent can choose not to claim the child as a dependent. The student then takes themselves as a dependent and can take that tax credit. Now, again, we don't always see that much of a benefit potentially unless the child has significant income and probably filing their return already. If it's American Opportunity Credit, they still could be eligible for that $1,000. A couple things we may need to watch. We'll talk a little bit more about that economic impact payment coming up here, but that can have some impact as to where that student has been taken as a deduction before.
Got it. Thanks. Next question. Are there estimated quarterly tax payments required for local income tax as well as the Fed and state?
There are. So if the individual's making federal estimated payments, they could potentially be also making them for state and local purposes. Oftentimes where we may see some situations maybe for someone who has a significant amount of maybe dividend or interest income, and then also has Social Security income. Social Security can be taxable for federal purposes. And so if the individual decided not to have any taxes withheld from Social Security, they may be making estimates. So the Social Security is not taxable for PA or for local. So they might only have federal estimates. They're relatively easy to make, but they could also have Pennsylvania and local as well. So if they're making estimates, we just want to probably double check to see if they're doing it for state and local purposes. We'll talk a little bit more about state and local in our last session here coming up in 2 weeks.
Got it. Thanks. And then our last question, unless someone else puts one in chat. If someone is blind, but they have earned income, do they get a higher deduction for being blind? Also, do you get a higher deduction for other types of disabilities?
So there is an increase to the standard deduction for either age or blindness, but it has nothing to do with earned income. So it's not actually an earned income component. But the only ones that we see an increase in the standard deduction would be for blindness. So that's really our only really change that we'd have for a deductibility perspective. Unless there's another kind of deeper part to that question. But traditionally what we're looking at is your standard deduction would be higher if you're considered legally blind. And there's actually a checkbox in the intake form or the intake area that can indicate that the taxpayer is considered blind for tax purposes.
Okay, thanks for that. And those were all the questions.
Okay, wonderful. Well, keep them coming. We'll have some time here at the end of the presentation, but wanted to get back into a couple other big ones and really want to kick it off with one of the largest credits and kind of the festive environment we have here with the question slides really going to be carrying over here because we're going to be talking about the earned income credit. One of the big things that we see in credits, this is a refundable credit. This credit is actually the one that probably is responsible for more refunds than any other element on the tax return, especially for VITA. A lot more information found on the I-12 in your 4012. And again, I also want to refer back to other materials that you have as well. The 4491 is also a great resource to be able to find more information about any of these items that we're talking about. Also, some of the other material actually has some pretty nice examples and some self-quizzes to go through in case you're wondering about application for some of these areas. Now, the earned income credit is actually designed as a refundable tax credit for people who are working, obviously earning income, but don't have that high of income. So what we're taking a look here is people who have jobs, they have some sort of earned income, but they're not having a significant amount of income. It actually will allow them to have a fully refundable credit, which not only gives them their income tax back that they had withheld, but also gives them more money back. So it's actually a super credit, if you will. And it's actually been even supersized for 2021. So what we're going to see for 2021, there are a couple changes that are going to apply only for the current year, unless we see some changes from Congress. I don't believe, I just was on a conference call earlier today about the what we believe we're going to see out of the final reconciliation bill. And I do not think we're going to see any more tax credits coming through in order to get this to pass under the Reconciliation Act. But for 2021, we're going to see that maximum credit is nearly tripled, especially for people who are without children. So certain taxpayers are going to see a much higher opportunity for the maximum tax credit. Another massive impact that we're going to see is that the credit's now available both to younger workers and senior citizens. So the age has now dropped from age 24 down to age 19. So anyone 19 and older can now claim the credit. Now, there is an exception for a college student. So if you are considered a full-time college student for at least 5 months out of the year or any part of 5 months out of the year, you are not eligible for the earned income credit. But if you're 19, 20, 21, and you're not in college, at least on a half-time basis, you can actually take the earned income credit now. Another one that we're going to see is actually senior citizens. We used to have an age limit if you were over age 65, you could actually only take the earned income credit if you had qualifying children. That has now been waived for 2021 only at this point. So senior citizens, people who now may be taking a part-time job or having some other income, maybe they're self-employed, can now be eligible for the earned income credit at age 65 and older. We also have another election. Now, this was actually in last year as well, that if you had a higher earned income in 2019, that you could use the 2019 over your 2020 earned income to calculate your earned income credit. That's been continuing. We can still use your 2019 earned income to calculate your earned income credit as long as it's higher than the 2021 earned income. So you can make an election to do that. You would have to get the tax return from 2019, looking effectively at your wages and your self-employment income and a couple other things we'll mention a little bit later, but that is, again, another option we have for the current year. So other changes we see for 2021, and these will actually continue moving forward. There's actually a change in requirement that children have to have Social Security numbers. So taxpayers and spouses, if you're filing jointly, have to have a Social Security number. They cannot claim the credit if they do not. So if the taxpayer and spouse have a Social Security number, they can still claim the earned income credit even if their children do not. So it used to be in the past that everyone on the return had to have a Social Security number or else you would be disqualified. So if both parents had one and the child had an A10 or an I10, they could not take the earned income credit. That requirement has now been waived. However, if they have a child that is not with a Social Security number, we have to go back to the table for people without children. So the children will not disqualify from the credit, but they will not be allowed to be added to the table with taxpayers with children. Another big one, and I know we've run into this situation a little bit in the past, so VITA not all that common, however, but the investment income limitation has now been bumped up to $10,000. Was right around $3,200, I believe, in years past. That is now up to $10,000 and now also indexed for inflation, meaning that each year that number will be going up from $10,000. So other than that, those are the massive changes we've had. The other requirements are still pretty much the same. You have to have earned income, either through wages or self-employed business income coming off of Schedule C, potentially long-term disability payments you're getting based on the fact that you can't work. If you're getting them prior to minimum retirement age, you'll be getting a code 3. That would be considered eligible earned income. Again, as we mentioned, you cannot have investment income above $10,000. Filing status has to be anything other than married filing separately. If you're filing separately, you cannot take that. The taxpayer and spouse, as I mentioned, have to have Social Security numbers. If you want to get into the qualifying children route, all of the children have to have Social Security numbers in order to be considered qualifying children. They cannot be a qualifying child of someone else. And another big one is you cannot have been disallowed a credit in a prior year. The IRS will actually reject e-filed returns if the credit has been disallowed in a prior year and we're trying to take it for the current one. Now, what's interesting is we also have a change in the qualifying child rules. So it's very similar to the dependent rules, except a couple things. One, the support test goes away. So if a child provides actually more than half of their support, they can still be considered a qualifying child for purposes of the earned income credit. Likewise, we have a residency test that allows the child to be claimed only if they live with the taxpayer for over half the year. So they have to be a U.S. citizen or resident for the entire year, and they have to have lived with the taxpayer for more than half a year. What this means is that you may actually have, in situations, again, a non-custodial parent claiming the child for dependency purposes and the child tax credit, but only the dependent parent, the custodial parent, can claim the child for purposes of the child and dependent care credit and the earned income credit. So that still allows the individual to go ahead and take the earned income credit with the qualifying child. So it has to be the individual or the child spent more than half the year. One other situation that does come up every once in a while is what we call a Medicaid waiver payment. So Medicaid waiver payment is effectively for taxpayers who are being compensated under the Pennsylvania Medicaid waiver program because they're providing care for individuals inside their homes at basically non-medical care So they're not a licensed physician, not a licensed registered nurse, but they can provide some level of care. That can be feeding, clothing, bathing, any other type of support services. Typically, that income that they receive is going to be reported on a W-2. Now, however, they are exempt from taxable income. So for the W-2, there's actually under box 13 in the W-2 input screen, you can actually enter the payment amount for the Medicaid waiver program. That'll actually make it tax exempt. And then you can also check a box right there, right above the amount that you entered. And that will treat that income as earned income for purposes of the earned income credit calculation. So that actually allows you to get earned income, even though it's not taxable for federal purposes. This is a rule change that we had back in an IRS notice 2014-7, which actually allows that. Again, the 4417, I believe, has more information on that as well. But just want to talk a little bit about how these credits have been expanded. So just want to show you the tables real quick here. Again, you don't need to memorize these. Our software is tremendously good at calculating earned income credit, but just want to show you where the earned income credit has a lot more applicability. So the biggest change we have is that for qualifying children, now we do not need to worry about anyone over the age of 65 or anyone under the age of 24. As long as you're 19, again, unless you're a qualifying college student, you're eligible for the credit as long as your earned income is less than $21,430. So the table I'm showing you here is actually for single, head of household, and qualifying widow or widower. The maximum credit has gone up from about $532 up to $1,500 is the maximum credit. So we may be seeing a lot more people filing returns or being eligible for the earned income credit because of those changes. The reduction of the age, the elimination of the older age cap, and also a higher maximum credit may have more people eligible. Now, the numbers go up the more children you have. So if you have one child, now you can have earned income up to $42,157. Your maximum credit is a little over $3,600. If you have two qualifying children, you can earn almost up to $48,000 of earned income before the credit's no longer applicable. Maximum credit's almost $6,000. If you have three or more children and you only need three, you don't need to have 14 or more. You can earn just up to $51,464 and still be entitled to the credit. And the maximum amount is $67.28. So it's a fairly high amount of credit. The same type of credits are going to apply for the married filing jointly. What you're going to see as a change is actually the earned income in the middle here. So that actually bumps up not twice the amount. So we're seeing a little bit of a discrepancy there. So that it's not twice the amount as a single individual or head of household, but it is a little bit higher. So if you're married filing jointly, you don't have any children, you can get up to $27,380. So if you're a married couple that are over the age of 65 and both of you are working and earning $1,000 per month at a job, that's $24,000 per year, you would still be eligible for the earned income credit. So just want to show you a little bit of how powerful that can be. And we may be seeing a lot more of the earned income credit. So other than those changes in kind of the age, again, which is caught by the system, we're seeing just a little bit more of applicability in terms of the increased earned income and the maximum credit. But again, the system will be calculating that for you. I do want to let you know that, again, we'll probably double check the COVID policy at your sites. But with these higher earned income credit amounts, you might be having people tempted to hug you. So I'm not quite sure what we're doing about contact at the sites, but guaranteed taxpayers are going to be pleasantly pleased with these increase in the earned income credit. So you'll see hopefully a lot more smiles than frowns and sadness this year. So I want to talk about another area that we for 2021 only, and that's going to be the recovery rebate credit. Again, more information on the the H8 of your 4012. This is what we believe to be the final economic impact payment, the third one that was actually distributed out right around April or so timeframe, which was actually, again, an advanced credit based on the 2021 return. So what we're looking at here is U.S. citizens and U.S. resident aliens were eligible to receive that $1,400 credit. So if they were filing jointly, they'd each get $1,400 as long as they were not a dependent of another taxpayer as long as they had a work eligible Social Security number, as long as they meet the AGI threshold. So I just put these in for your reference, but all of these are underneath our threshold for VITA. So they would be all eligible if they're coming into VITA. It's 150 for married filing jointly. We're taking a look at 112,500 for head of household and 75,000 for everyone else. The other unique part is that you could also get a $1,400 credit for each of your qualifying dependents. So a little bit of a change that we had from the first two economic payments, which were actually applicable for the 2020 year. So you could get a $1,400 credit if you're going ahead and claiming a college student or qualifying child, and other dependents are also eligible as well. So a parent or someone else you're claiming on the return. Now, why is this important? Well, these advanced payments are actually intended to get the money in the hands of the taxpayers before they file the returns. Now, there could be a situation where potentially the taxpayer did not get a economic impact payment, or they did not get the full amount. So we do want to confirm how much they actually received. So be on the lookout. Again, the notice 1444-C should have been given to the taxpayer shortly after they received their economic impact payment. Again, what we are expecting to see from the IRS, that they're intending to have a lookup feature, almost similar to what we had last tax season, to say, where's my stimulus, that should be eligible for us to go ahead and confirm the amount that the individual has already received in advance. If they received an advance payment for the economic impact, we'll do just what we had done last year. We'll actually enter that amount in the tax software, and it'll calculate. If they've already received their $1,400 for themselves, they don't get another round of it. If they are not eligible for it this year because their income went up above these thresholds, they're allowed to keep it. But if they did not get the full amount, if their income went down or something changed, then they can get that balance available during our current filing season. So this, I believe, is the last time we'll be talking about economic rebate credits and stimulus payments, but we'll see what happens coming up in the next year. One of the other areas I wanted to talk about here is our common deductions within VITA and which ones are actually going to be within scope. Now, just to let you know, the majority of our taxpayers are probably going to take the standard deduction. So the standard deduction is a whole lot higher, increase since 2017, to really kind of capture a lot of those other expenses and prevents the need to itemize. So we're going to probably see most of our VITA clients are essentially going to be taking the standard deduction, but I do want to point out a couple of situations where we may see itemization. The biggest ones we're going to see are for people that have significant medical expenses. And when we mean significant, it has to be over 7.5% of their adjusted gross income. So as an example, if they have income, and I know the AGI would be fairly high, but $50,000 of adjusted gross income, 7.5% would mean they need over $3,750 of medical costs out of pocket to get at least $1 of deduction. And then they still need to get over the standard deduction level. So we don't often see medical and dental expenses by themselves qualifying. Now, I do want to mention that we do have some other opportunities. If an individual's in a retirement home or paying for care, then that could help them qualify. But another situation we typically see people itemizing could be people that are homeowners. So homeowner is going to be getting a Form 1098 from their mortgage company showing how much they paid in home mortgage interest. That is allowed as a deduction. So anything coming off the 1098 should be in pretty good shape. Now, we do have some issues on home equity loans. Those can only be deductible if that is used to either acquire or basically buy or build or improve the taxpayer's qualified residence. So we may be seeing people taking advantage of the increase in equity in their home and actually doing some home mortgage equity loans. If those proceeds are used to pay off credit card debt, or if they're used to pay student loan or a car or something else along those lines, that's not deductible. The home equity has to be used to buy, build, or improve a property. Mortgage insurance premiums are also back in again for this year, much like they were last year. We'd find that information again on that Form 1098 and enter that in directly. Real estate taxes, again, are deductible. That is actually in the same input section we'd have for the mortgage interest. One other caveat we have, just to mention the real estate taxes, the state and local income taxes, we still have a $10,000 cap on the amount of taxes that can be deducted. So even if an individual has more than 10,000, as of today, we are still capped at 10,000. I know that there's been some discussion of whether or not that the what we call the SALT cap is going to be lifted with the reconciliation bill that's going through Congress currently. Again, the latest I'm hearing from our Washington pundits is that that is not going to make it through the Senate. I don't know if it will or not, but right now we still have a $10,000 cap. We will let you know about any changes to that before we start the season. And again, the software will automatically pick that up. Also want to mention that gifts to charity do qualify. And again, if we don't get to the level of itemized deduction, we still can take those as that charitable deduction on the return. So the $300 for all filing statuses, up to $600 for married filing jointly. Do want to remind people that the documentation rules do apply. So we generally take the information given to us by the client, but we're not the ones who have to verify that. That'll be between them and the IRS at some point in time if they're audited. So again, substantiation rules, documentation rules. If you have more than $250 of a charitable contribution, you need to have written acknowledgement from the charity of that donation. So there's certain language that needs to be part of that process, and hopefully they have it and can hold on to it. Now, certainly you don't need to have substantiation. Again, if you're around doing some shopping, the Salvation Army has their buckets out already. If you drop a couple dollars in there, that's fine. Go ahead and keep track of those. If you're going to give a substantial amount of cash, $10,000 or more in cash, it might seem a little tacky, but you may want to go ahead and take a picture, a selfie, if you will, dropping the money into the bucket, probably with the Salvation Army bell ringer, giving a big thumbs up and being a big smile on the face. We do want to document that you've made that contribution for IRS purposes. Now, when we talk about charitable gifts, now it has to be directly to the charity. So oftentimes we get questions from people to say, if I buy a box of Girl Scout cookies, can I take a charitable contribution? No, you cannot. You're getting a product back. If you're entering, say, a 5K that's for a charitable benefit, you're paying the race organizer an entry fee. That is not a charitable contribution. Technically, the rounding up or donating at a restaurant or things like that do not count either. They have to be a direct gift to a qualified 501c3 charity. So again, just a reminder to taxpayers. So you can actually also deduct gambling losses as an itemized deduction up to the extent of your gambling winnings. A little bit more information on F11 there. But generally, these are not in and of itself going to get you to an itemized deduction. As I mentioned in our last session, I believe I mentioned it, I have a client who had $62,000 plus of gambling winnings from online gaming in 2020 while they were quarantined. They had that reported to them on the appropriate government forums. However, they lost it all. They kept putting the money in and they kept losing it. So we were able to take that as a itemized deduction because of the substantial nature of their losses. That actually gave rise to having them itemize their deductions for the year and help offset their gambling winnings. Now, if you only have $1,000 of winnings, you can only take up to $1,000 of losses. Again, the substantiation would be on the taxpayer to either bring in for the IRS all of their scratch-off tickets or Powerball tickets that didn't win, or maybe getting a statement from their gaming place of choice to show how much that they've accrued in points or anything else that show their losses. The substantiation will be on them. But if you only have $1,000 of winnings, your $1,000 of losses probably will not get you to an itemized deduction perspective, at least on its own. You're going to need a lot more than that. Just want to mention a little bit more about some of those medical costs that we had talked about for the 7.5%. Now, when we talk about medical expenses, it's actually fairly broad. So it can apply for the taxpayer, the spouse, any dependents on the return, but we brought that up quite a bit more. So it could be anyone who could have been a dependent on the return, except they didn't meet the gross income test. So this would be someone who might have been a qualifying relative, maybe an older parent or a sibling or someone along those lines, but they had more than the $4,300 of gross income. Well, if you're still paying the medical expenses for them, they are actually eligible to be deducted on your return. So the gross income test does not apply. If the individual could have been dependent, except they file a joint return, that doesn't matter either. Or they could be claimed as a dependent of someone else. So kind of typical situation might be you have parents that are separated. The child is residing with one parent. being claimed as a dependent of that parent, but the other parent is actually paying for the medical costs, those would be deductible by the person actually making the costs. Now, there's actually a really interesting, if you ever have time that you are running out of things to binge on Netflix or nothing on TV, you could go ahead and take a look at the form or the publication 17. So there's a table 21-1 that'll actually give you a list of all the types of eligible costs and all the ones that would not be eligible. So traditionally, medical costs would be deductible. That would be your copays, dental costs, vision costs, any prescription medication that you have, any long-term care premiums. If you're driving for medical appointments, those all qualify. Things that are legally prescribed, and I probably should emphasize that a little bit more for that prescribed medication and programs. So the medications must be prescribed by a licensed doctor and purchased legally inside the US. So ordering things from the Mexican or Canadian pharmacies don't count. They have to be prescribed by a licensed physician. They have to actually be purchased legally in the US. So if the medication is not allowed under US law, under federal law, it is not allowed as a medical expense. If you're getting it from a licensed pharmacy, you're probably okay. If you're buying it on the street corner, it's not going to be okay. So there's some very unique rules about what counts and what doesn't count. Usually these arise by someone trying to take the deduction on the return and the IRS disallowing it. We've seen all kinds of things like trying to take dancing lessons to improve mobility, to people trying to put a swimming pool in for aqua therapy. So there's a whole list of things that count and don't count. But just to give you a little bit of a heads up that people may be tempted to bring in their medical receipts, that they're being told, hey, save these for tax purposes. We may just want to double check. First of all, did they add all of them up for us? Because that's going to save a lot of time. We really don't have a lot of time with the client appointment to go through and start adding up all of their $3 copays and prescription receipts. Hopefully they've added that up for us. Again, they might have an opportunity to go ahead and get a summary statement from either their pharmacy or perhaps their physician's office can give them a summary, or their medical insurance program might give us a summary of the out-of-pocket, which would help. But we don't often see medical expenses themselves driving itemized deduction. We just have a lot of hurdles to get over. But just want to make that a point in case we do get into those situations. So again, we're probably not going to see a whole lot of medical expenses and even itemized deductions, but just want to point out what they can be. And as you can probably tell, the IRS just loves to hit a couple of these questions on your exams. So wanted to point that out for studying purposes as well. Now, kind of talking a little bit more about medical, but shifting gears a little bit, just want to talk about the Affordable Care Act. So this is applicable for individuals who are buying their medical insurance through the marketplace under healthcare.gov. We're going to hear this several times, that we need to get this Form 1095A in order to complete a tax return. So for the past couple of years, we have not had a shared responsibility payment for people who have not had health insurance. So the failure to have health insurance, we have not had a payment, not called a penalty, that would be illegal, but we do not have a shared responsibility payment for failure to have health insurance. That did not change. That is still in play. What did change, however, was the 2020 rule that if you had an excess advance premium tax credit, you did not have to pay that back. So that was only for 2020. We're going to see some changes back to having to pay money back if you're over the premium credit. I'll talk about that in just a little bit. So one of the ways we're going to be able to tell is there's going to be a question on the tax layer program when you go through to ask about health insurance. So the question is going to be, did anyone purchase health insurance through the marketplace or healthcare.gov? If yes, then they're going to ask for each person on the return, did they actually get health insurance? And if yes, we have to complete that Form 8962, and we're going to get that information from the Form 1095A. So again, critical that we actually get that. And just a little bit, I'll tell you how to get that information if the taxpayer either does not have it or did not bring it with them. But often what happens is, particularly for our clients within VITA who are taking advantage of the marketplace insurance program, is that they are eligible for a premium tax credit. So in order to help make the health insurance more affordable, there's actually a credit that is attached to that. So as long as the individual is buying their health care through the marketplace, there are a couple requirements that cannot be eligible for health care through other
other means. And as long as they have what we call minimal essential coverage, they're actually allowed to go ahead and take the credit. So this is actually designed for people who are above the poverty line. If they are at least 100%, but not more than 400%, that's where we're intending that premium tax credit to be. We've had a shift. So it used to be what we call a cliff. If you had more than 400% of the federal poverty line or poverty level income, you were not eligible for the premium tax credit. It's a little bit softer now for 21 and 22 as we take a look. But basically, if an individual has gotten health insurance through the marketplace, they should have been eligible for the premium credit, and they most likely had taken that as an advance credit payment. So when you sign up for health insurance through the marketplace, they're going to have you estimate your amount of income that you would expect to have for the current year. And they're going to base that credit based on your estimated amount of income. And that credit is then applied against your monthly insurance premiums. So the monthly insurance premiums that you have, if it would have been $800 for a plan and you have a $500 credit on a monthly basis, your net cost is only going to be $300. But now bear in mind, you actually just now received $500 a month for 12 months. You actually got a $6,000 tax credit over the course of 2021. So what we need to have, we have to get that Form 1095-A. If anyone has taken an advanced premium credit, we have to file the Form 1040. Going all the way back to session number 1, we talked about who has to file. Anyone getting an advanced premium credit has to file a return. And again, we need the information from the 1095-A that should be coming from the marketplace by January 31st. If the individual did not get it, they can always log into their marketplace account or give the marketplace a call at the 800 number listed both here in your slide and then also in H14 of your 4012. So if they have taken the premium tax credit with advance payments, we're going to have to complete the Form 8962. Again, TaxSlayer is going to go ahead and do this for you. What's going to happen once you indicate that the individual has a Form 1095-A, they're going to have you enter the information from the 1095-A into TaxSlayer. If every month is exactly the same and you have the total amount, you can just enter the total. If there are changes, then you have to just enter the form exactly as shown into TaxSlayer. It's going to go through some calculations. So TaxSlayer is going to go ahead and calculate the amount of the credit for each payer based on different criteria. In some cases, they may actually be entitled to more credit than what they actually received. And that's the case, they'll actually have a refund on their return or at least reduce the amount of balance owed. However, if they got more money in credits than what they were entitled to, they may need to repay some of that if they actually had higher income. So this more likely than not happens within VITA. An individual estimates their income for the year, and then something may happen. Maybe they have capital gains, or maybe they have gambling winnings or something along those lines that will actually push their income up a little bit higher. Now, they always could have changed that with the marketplace. If the taxpayer knows that their income's changed, they should contact the marketplace immediately to prevent the repayment. So we're looking at a little bit of a softening here. So if you're above the 400% level of federal poverty, and again, that'll be automatically calculated within TaxSlayer, the payment could be relatively high. Now, it's going to be softened a bit again for 2021 and 2022 due to some changes we've seen recently, but it still can be a fairly onerous repayment. Like I mentioned, if you're getting a $500 a month credit, that's $6,000. Now, not all six may have to be repaid, but it could be a significant amount. If we can get the individual below the 400% level, it can be capped. So you don't have kind of an excessive amount. So a couple of the strategies we had talked about earlier, how do we reduce our taxable income? Well, what if we contribute to an IRA? Or we're going to talk about an HSA in just a little bit. Or if that tuition and fee deduction comes back, maybe that's better for us than a tax credit. So there can be some things that occur that we can help potentially use our available resources to adjust a taxable income for an individual. And then hopefully at that point also reduce the amount that they may owe to the government. So this is one area, probably the worst part we'll be talking about tonight, that we may have additional payments due by our clients. If this happens and we're seeing that we have a large payment due, again, if you're preparing a return and TaxSlayer, you look in the upper right-hand corner, it should be calculating the amount of refund or amount due. If you see that amount get pretty big on amount due, don't panic yet. Take a couple deep breaths. You don't want to scare the client. Just take a look and see where we're at. We may have some additional opportunities. If the taxpayer owes a lot of money, they're probably not expecting to walk out of the site in just a couple minutes with their return and ready to pay the amount due. We have to take a little bit more time. That would be fine. That would not be a problem for us to review some options with them, either to potentially reduce their taxable income or at least give them some payment options of how they can pay that amount back. But just wanted to kind of point that out. Couple situations as well that we can't handle within VITA would be for any newly married taxpayers. That gets a little bit more complex, or if they have some sort of shared payment calculation, they get a little bit complex for VITA as well. Okay, moving over to another area. And again, this slide will eventually go away. This is for first-time homebuyer credit and repayment. So this is for individuals who actually bought a home in 2008 and actually had gotten a credit from the government to do so. They have to repay that, pay the credit back over 15 years, starting in 2010. So for those of you who are going to be with us here in 2026, you will not see this slide again. It'll be off at that point in time because our 15 years will be up. So typically the first-time homebuyer credit, we will have seen it on the prior year return. They may have been getting a notification from the government to remind them that they have a repayment due. Or you could actually use a lookup tool on the irs.gov. And again, more information on the H2 about that. So that would be a couple other unique situations we may have if the taxpayer dies or they sell their home or they're no longer using it as a principal residence. We may have to take a look at some credit repayment on the form 5405. We don't often see this, but just want to make mention of that for any first-time homebuyer credit and repayment options. And now we're going to head into our last discussion of the evening, and that'll be on health savings accounts. So the good news is this used to be a separate certification, not a really tough exam, but required a separate certification, and is now part of the advanced certification. So if you are taking the advanced test, the HSA is actually going to be part of that now. More information will be found in E6 going all the way through like E8 on your 4012. We're seeing a lot more in popularity of what we call high deductible health insurance plan. And what a high deductible health insurance plan is that it's a relatively high amount of out-of-pocket expenses. So the deduction is really, really high, the deductible level before insurance kicks in. So we typically see this a lot with maybe younger people or people that don't use the doctors that often, and they're willing to take the risk that they don't have a lot of medical costs before insurance will actually come and help cover those payments. So you can either pick a self plan or a family coverage. So the self plan for 2021 would be a $3,600 contribution limit for a health savings account. Family plan would be a $7,200 contribution for a health savings account. And if you're age 55 or older, you actually get another $1,000 that can be added to that. So the benefit of a high deductible health insurance plan is that you actually get to establish these health savings accounts. And these are a tax deductible account that basically grow tax-free as long as you use those proceeds to help pay for your out-of-pocket medical expenses. So those include things like your copay expenses. It can include things like your medication. It could include things like eyeglasses, dental appointments, that type of thing. Another change we have, over-the-counter medication is now allowed for HSA deductibility. So we're going to take a look at how we can put money into the HSA and how we take money out. So typically what we're going to see is an HSA is generally through an employer-based relationship. So typically the employee or the employer may make contributions to the HSA. Typically what we see is that would be in box 12, the W-2, usually a code W for an HSA contribution. Oftentimes the taxpayer is also going to get a form 5498-SA, which is going to show their contributions for the year. Most often, all of these contributions are going to be made on a pre-tax basis. So if they're going through what we call a cafeteria or Section 125 plan, you do not get an additional deduction for those. So if it's through payroll withholding or employer match or employer contributions, we do not get an additional deduction. However, oftentimes there are ability for the employee to make additional contributions, again, up through the due date of the return. So if the employee makes any after-tax contributions, we can be eligible for a tax deduction. And it's also eligible for a Pennsylvania deduction as well, contributions to an HSA plan. So we'd report any contributions and distributions on the form 8889. Typically, again, if you put the code W in box 12 of the W-2, it should populate the HSA. We would just need to go ahead and enter any additional out-of-pocket, after-tax contributions that the employee may have made. Now, taking money out of the account. Any distributions from an HSA are going to be showing up on a form 8889. That's where we're going to show that. Typically, the taxpayer is going to be receiving a form 1099 SA. As I mentioned before, anything that has a 10, a 0, and 2 9s in it, the government gets a copy. So the government's going to want to show that we are identifying whether or not that these distributions are considered non-taxable. And traditionally, distributions from the HSA are going to be not taxable as long as you're using it for qualified medical expenses. And it can be for yourself, your spouse, and your dependents. Or if that distribution was rolled over to another qualified HSA, then you're in good shape. So again, we're taking a look at what is considered deductible. Again, it is pretty much what we'll see from the itemized deduction perspective. Your co-pays, other insurances you may have, glasses, dental work. Again, now we do have the ability for over-the-counter medication to be allowed as an HSA distribution. Fortunately, most times the HSA is limiting how you can get cash. Oftentimes, people that have a health savings account will have a debit card that can be used to actually withdraw money from their account, but it cannot be used at an automated teller machine. You can't get cash out of an ATM, but you can use that at pharmacies or a doctor's office for a copay. Typically, it can only be limited to certain areas. It will not allow you to buy gas with an HSA card. So usually we don't see any ineligible distributions. So we just have to ask the taxpayer if you see a 1099 SA, just to ask, did you take this distribution out for qualified medical costs for yourself, your spouse, or your dependents, or did you roll it over to another HSA? If that's the case, we'll just put the exact same amount of eligible distributions under the amount that the individual had taken out. Now, if for some reason they figured out a way how to get money out of their HSA, and typically the way you do that is you have to request a reimbursement check from the HSA itself, that amount is now taxable income. And as we mentioned back in the income section, the Form 1099-R, an early withdrawal from a retirement account equated to a 10% penalty. The HSA is even worse. It's a 20% penalty if you take your money out of that account and you do not use it for qualifying purposes. Now, you do have some exceptions. If there's a death of the taxpayer, or they're disabled, or they've gotten to age 65, then you're okay to take money out of the HSA without a penalty. It will still be subject to income tax, but just not a penalty. So just want to kind of do a couple quick reminders on the HSA. Fortunately, the HSAs are fairly straightforward in process. Still a little unsure why we had a separate certification for that in the past, but glad that the IRS changed their minds and put it just under our advanced certification. So wanted just to kind of wrap up there for the evening and just see if we have any additional questions coming in, either through chat or otherwise, that we can help answer for you this evening.
Okay, thanks, Jared. I have some questions from the morning session. If you do a 2019 earned income credit look back, if there is a zero, if you have zero 2021 earned income?
Yes. So theoretically, the look back should allow you to use the higher of either your 2019 earned income or your 2021 earned income. So if you don't have any earned income in 2021, you can look back to 2019. Now, the question that we need to resolve yet is, because we've just now for 2021 allowed people to qualify that have never qualified before, whether or not the IRS is going to allow people age 65 or older, or those people between 19 and 24 to kind of go back and pull income from a prior year and use that for the current year. So I'm not entirely sure how that's going to play out yet. We'll probably need some additional guidance, and whether that is what Congress had intended when they had made that change. But we'll keep people updated on that. But yes, for anyone else who is eligible, you can use the higher of 2019 or 2021 earned income.
Okay. How can a recovery rebate credit affect a tax refund?
All right, so the recovery rebate credit is basically, again, it was an advance payment coming to taxpayers. So if you had gotten your full $1,400 paid in advance, you don't get that credit again on your return. So if you, I'm sorry, is this, I should probably clarify, Jeff, is this for the advanced child credit or the economic payment?
The recovery rebate, the stimulus.
Okay, perfect. All right, good. So yeah, sorry, I had confused myself in the middle of the answer there. But yeah, so the stimulus payment is an advance on 2021. So if they paid you too much and your income's gone up again, we probably won't see that with VITA. You get to keep the difference. If they paid you the full $1,400, you do not get additional amounts here in 2021 unless you have a change in the circumstance. If you have a child who was born in 2021 or you added some dependents, you might be eligible to claim them on the return. So much like we've had in the past, in last year, you'd actually enter the amount that you have received in advance. And then if you did not get the full amount, then the tax software will automatically calculate the additional amount that you're entitled to receive. But if anyone has gotten that payment already, they're not going to get it a second time.
Okay, got it. Next question. If a taxpayer plans to make a late contribution to an IRA or HSA, does VITA hold the return until the taxpayer provides proof they've made the contribution?
Yeah, so again, the HSA and IRAs are allowing you to make a contribution up to the due date of the return. We are going to go ahead and prepare the return for the taxpayers to file based on their word that they're actually going to go ahead and do it. So it's going to be incumbent upon the taxpayer to actually make that contribution by the return filing date. So we would not necessarily have to hold that. We would take them at their word that they're going to go ahead and do it.
All right. Next question. Does the taxpayer need to provide evidence to VITA of gambling losses in order for us to itemize?
So we would need to know the amount of gambling losses, but again, with most other pieces of information, we can take the client's word as long as it seems believable and without any suspicious nature. It's going to be up to the taxpayer, however, to maintain the documentation in case the IRS comes back and questions those deductions.
All right. Are over-the-counter drugs now covered under HSA?
Yes. So actually, fortunately, a rule change in 2020 allows over-the-counter drugs to be eligible for HSA distributions. They're not allowed for itemized deduction purposes yet, but they are allowed for HSA and actually flex spending arrangement accounts if someone has that with their employer. But over-the-counter is allowed because you're going to have to keep track of all your aspirins and other things along those lines, but they would be considered eligible.
All right. If a student is over 24 and taking full-time education credits, could the student qualify for EIC?
Yes. So the restriction is only for students up to the age, basically under the age of 24. So if they're over that, yeah, they would still be eligible for EIC because that would actually preclude them from being a dependent on their parents' return unless they didn't have qualified earned income. If that's the case, they probably don't need to worry about their earned income credit. But yes, if they're over the age of 24 or 24 over, then they should be fine.
All right. Do Social Security, pension, and 401k income count towards the earned income credit?
No. So the only thing that is would be happening for those, the only thing that counts as earned income would be anything that would be actually earned. So it has to be wages, it has to be self-employment earnings. So we do not have the ability to treat unearned income for the earned income credit.
Okay, and so I'll unpack this a bit more. How would that affect AGI? Would those incomes be part of the AGI check?
Yes, yes. So they would impact adjusted gross income, but they would not be eligible for earned income. So it's not going to actually give you any earned income opportunity there. But it would be potentially increasing your AGI, although Social Security may not be fully taxable. So that might not come into play there.
Mm-hmm. Okay, got it. Sorry, there's kind of a repeat. Yeah, sorry, same question. And then next question, if someone did not receive the stimulus payment and he or she qualifies based on 2021 income, will they get a $1,400 credit like they would have last year?
Yeah, so if they did not get the third stimulus payment, but they now qualify in 2021, And we've actually seen this. We've had some taxpayers that for whatever reason, their return processing was delayed, or maybe they just never got the money, or they were ineligible for some reason. Maybe they didn't file returns. Yes, they can actually get that $1,400 when they file the 2021 return. So very similar to last year, if they did not get the full amount or any of the amount, they can actually go ahead and take care of that.
Okay. This is about charitable contributions. Do some memberships to societies, Smithsonian, for example, allow some part of the contribution to be considered a charitable gift, even if you get member benefits?
Okay, so
Like
yeah, so yeah, if you theoretically, if you're getting some sort of benefit, the charity should be reducing the amount of charitable contribution by the amount of benefit you're getting. So if you say, for example, give money to the Public Broadcasting Corporation, and they say for $100 you get a contribution, but we're also going to send you a tote bag and a CD. So typically what you're going to get from the charity is that you've given us $100, but we've given you $20 back in some sort of value. So the charitable deduction would actually be $80, not the $100.
Got it. Okay. Can withdrawal from an HSA be used to reimburse prior year medical expenses paid in prior years if the taxpayer has receipts?
So typically it's only going to be eligible for expenses that you had incurred during the year. It typically would not be allowed for you to go back to open a prior year and reimburse for those expenses. So typically, I think we'd be looking just at the current year for 2021 expenses.
All right. Has the tax law on HSA changed if you're over 65 and withdraw money? Before you weren't taxed on withdrawals if over 65.
So as long as you're, so the HSA rules would allow for the penalty-free position. Now, for the age 65 and older, typically what we'd be looking at is if you have the qualified medical expenses, that could include any, it doesn't have to be directly related. If you have after, if you're paying for co-pays for medical insurance for things like that, that can actually qualify putting it into play there. So typically what we'd look at would be, whether or not that distribution would be considered an eligible distribution from the HSA to avoid income on that.
Okay. Looks like the last question here. Will there be a section in the tax layer that asks if we'd like to enter the 2019 AGI to assess, to do the test for the ITC?
I'm anticipating that we're probably going to see that within the tax layer program. I haven't seen it yet and didn't know. I didn't really look at it too closely last year for the 2020, but it would be for the earned income rather than the AGI. So it'd be taking a look at your earned income from 2019 as opposed to taxable income or AGI.
Yep. And it is there in this version. It's in the personal section.
Perfect. All right. Thanks for the clarification, Jeff.
Yep. Thank you. And that was it for the questions.
Oh, okay. Perfect. All right. Well, appreciate everyone sticking around on the Thursday before Thanksgiving here. We are going to take a break next week, so you don't have to worry about making sure you don't fall asleep during my presentation after having too much turkey. So we will meet again in 2 weeks to do the exciting conclusion of the VITA training and talk about Pennsylvania and local. And also we're going to cover military issues as well, if anyone would like to go through the certification for that program. But appreciate you hanging out tonight. I appreciate your questions. And if you have anything else, feel free to go ahead and email to Michelle or Jeff, and we will go ahead and make sure that they're addressed by our next session. So thank you very much. Hope you have a great holiday, and look forward to seeing you back here in 2 weeks.
Thank you, everyone.